Hello, everyone. I'm Ken Munkin, Chairman of Milliman. Today, we're going to be talking about inflation and the banking crisis, the impact on the life insurance industry. As you all know, the Federal Reserve has raised interest rates aggressively to combat inflation. This has led to stresses in the banking system associated with asset liability mismatches. We're not going to be going in detail and recapping bank by bank all the things that have happened. In this webinar, we'll discuss to what extent these stresses are found in the life insurance industry. In particular, the panel is going to discuss the current risks and opportunities and how the economic environment is leading to innovation in our industry. So we've got fantastic leaders of the life industry joining us here today to go through these issues. So let me give a brief introduction. Steve Walker. Steve Walker is Vice Chairman for Finance and Risk at Protective Life. Steve joined Protective in 2002 as CFO for the Asset Protection Division. Then he served as Chief Accounting Officer and Controller from 2003 until he became Executive VP and CFO in 2016. Since 2022, he served in his current role as Vice Chairman. Steve, welcome. Thank you for joining us today.
Thank you.
Also, we have Robin Raju. Robin, welcome. Robin's the CFO for Equitable Holdings. He's a member of the company's management committee. He's responsible for treasury, investment management, investor relations, M&A, actuarial, accounting, corporate tax, financial planning and analysis, expense management, and distribution finance. Robin, I don't know how you ever sleep. That's the longest list of responsibilities I've ever seen. So thank you very much for joining us today.
Thanks, Ken.
All right, let's jump right into the conversation. We're going to hit a whole range of topics associated with higher interest rates and the impact that's having as the effects roll through the life insurance industry. So, Robin, we're going to start with you. As you know, the Federal Reserve has raised interest rates aggressively to combat inflation. This has led to stresses in the banking system associated with asset liability mismatches. To what extent are these stresses being found in the life insurance industry?
Sure. Thanks again, Ken. Look, it's a good question, but I think there are significant differences between what the life insurance industry provides versus banks and how our products are structured. First, life insurers have structural protections that protect their asset and liabilities. For instance, market value adjustments, where clients can only withdraw the market value of their policy rather than the full benefit. So, for example, if interest rates go up, the bond value goes down, the client can only withdraw that bond value. They're not getting the benefit in some of the protections that we have. Second, other product features like surrender charges prevent clients from early lapses at the end of the day. So a client can if the client buys a policy 1 year from now, they want to leave, there's a surrender charge that goes with that, which compensates us for the distribution cost. And so that prevents clients from withdrawing activity. Additionally, as an industry, we provide millions of Americans with individual retirement accounts. And as a result, more than 99% of our retirement balances are in retail. So that means on the insurance side, we're not susceptible to instances where one large institution just pulls out a big chunk of assets that could lead to some losses that the banks had in their industry. So I think those are the structural protections we have. More importantly, people come to insurance companies for long-term savings. They're not coming because there's a rate that they want to collect for the next 3 months. We provide life insurance, retirement income, and guarantees that protect them in the future and allow them to live fulfilling lives. So they're not looking at us like a trade. They're here for the long term. And we've seen that through history that despite any crisis you look at, whether you go back to the pandemic, whether you look at the global financial crisis, persistency has been strong in insurance companies throughout the industry, and it comes back to the consumer need that we provide to clients.
That's fantastic. I mean, your summary shows that there's a mindset in terms of the customers, but then there's also strong structural, contractual reasons why life insurance companies have these stable liability structures on their balance sheet. So that's very good. Steve, let's go over to you. So if we could, let's zoom in on Protective as a case study. If you could talk about Protective's specific actions with regard to the larger financial stresses. So how is your company dealing with stresses in the banking system and disruption to the financial markets? And has your company taken any specific actions?
Sure, happy to. And I'll just make a couple more comments about the impact on the life industry from the stresses. And really, it's the inverted yield curve that's caused life insurers' funding cost increase. That's impacted some spreads on shorter duration contracts like funding agreements. The funding agreement-backed note market issuance, as an example, has slowed down dramatically due to higher short-term rates and disruptions in the financial markets. So that's one impact that we've seen at Protective. There's been some modest impairments and losses in some life insurers' bank sector investment portfolio, but nothing that materially impacted capital because we entered into this as an industry very strong on capital as well as Protective. Life insurers are also starting to see a little bit of an impact to profitability through lower variable investment income due to slowing of some of the prepayments that we're seeing on some investments such as commercial mortgages and corporate bonds. And we've certainly seen that at Protective, where some of our variable investment income, particularly in our commercial mortgage portfolio, where we get participating mortgage income on properties when they're sold, that's kind of slowed down due to the lack of prepayments. But capital in our industry is very strong, and many life insurers are really taking advantage of the strong demand for retirement products, really to kind of continue to grow their balance sheet at this point in time and maintain strong liquidity. But when some of the stresses really started in the industry back in March, and we saw what was happening to some of the banks, we assembled a cross-functional team that really started meeting 3 times a week, and that consisted of leaders from executive, treasury and ALM, ERM, investments, finance. We had a representative who runs our retail businesses, and also corporate communications, really to ensure timely communication and our market positioning. It's not that these groups were not working together before, but it really allowed us to kind of have a more frequent touch point so that we could react quickly and make sure we all knew kind of what was happening in the capital markets. And even today, we continue to be vigilant, but have now moved just to weekly meetings, just to make sure that we're monitoring our market positioning and really making sure that we're maintaining strong liquidity. That was really the main thing that we focused on, is having strong liquidity. We brought down some of our repo balance that we have, but Protective really has access to the Federal Home Loan Bank and regularly maintains about $1 billion of additional capacity with the FHLB relationships that we have. And we also have access to a $1.5 billion committed revolving credit facility. And most of our corporate bonds are public corporate bonds, and that supports overall strong liquidity profile. But Protective continues to kind of be concerned about, the banking market and just sort of, what higher rates will do to their balance sheet. So we're continuing to monitor the situation, but I think things have subsided some from what we saw back in March.
Wonderful. I love those examples. I mean, it's a great example of teamwork where you brought the executive team together from different functional areas, just working to figure out, okay, how are you going to respond? And then particularly on liquidity, it's not that you just have one strategy. You laid out this integrated, combination strategy with multiple sources of liquidity that kind of fits together. So that's a really great approach to it. So, okay, well, let's talk about a nasty topic of defaults. As financial stress increases in the system, obviously the way it ultimately manifests itself is that you have higher stresses on borrowers, throughout the economy, and that could lead to higher default-related losses. So Robin, going back to you, do you see higher default-related losses working their way through the life insurance industry in the coming year?
Sure. So look, if you take a step back from a life insurance perspective, credit risk is the best risk to take within a life insurance company. You can hold it at book value and you can manage through the volatility. You don't want to take risk like unhedged equity risk or interest rate risk in an insurance company. I think the best risk to take is credit risk. So as a result, you're right. Depending on where you are in the credit perspective, you could be exposed as interest rates rise and it increases the cost for a lot of market participants. You could be exposed to defaults. But again, it's important on where you play. At Equitable, 96% of our fixed maturity bucket is in investment grade products, and we continuously stress those asset classes, and we want to manage our risk profile across multiple cycles and not just plan for the current risk that we see in the marketplace overall. So I think if you're playing within the below investment grade space, some structured products, if high interest rates persist, it's going to put pressure on the borrowing capabilities and the credit profile of those companies. And that's certainly exposure across the whole credit market. But that being said, if you look at many across the industry, most of the industry is pretty well capitalized. And I think if you look at a lot of the stress tests, at least analysts have published, they can survive, severe credit shocks, similar to what the rating agencies put on. So yes, there's certainly credit risk out there. I think where you play is important. So being in the investment grade space is critical in this, and continuing to stress test is important as well. Like really stress those structured products for scenarios that we haven't seen before, right? Because no crisis is like the prior crisis is something that we always see. So test for things that you haven't seen before and ensure that you're prudent in where you put new money to work. So, but at the end of the day, the industry is pretty well capitalized. And I think the learnings from prior crises always help us hold more amounts of capital for the next crisis.
And one phrase that I heard you say several times was stress tests. And that's just been drilled into me, working in the life insurance industry now for over 30 years. You don't know what's going to happen. And so the industry has been exceptionally good at doing stress test after stress test. And we've seen the benefit of that as this episode has played out.
That's right.
Yeah. Steve, any comments that you have with respect to the topic of defaults?
Yeah, I just would say so far losses and impairments have been, pretty modest. They mainly have come from some of the failed banks where some, insurance companies, including Protective, had some positions there because we invest in public corporate bonds, and that was part of the overall universe that we played in. We've had some limited ratings migration due to downgrades of some banks, but as I said earlier, we have, as an industry, a very strong capital position, and really the impact's been relatively modest. And so far, really, investment grade bonds have performed well, and credit spreads have not really widened, which is kind of surprising given some of the stresses that have been out there in the system. One area that I know we'll talk about a little bit later is on commercial mortgage loans, really related mainly to the office building sector, is a risk that could take some time to play out for that type of investment. But again, I think it's very manageable for the industry.
Very good. Robin, any comments that you have on commercial mortgage loans? I mean, that's something that's just come in the news so much. And I think what's lost on people is the approach that life insurance companies come to the commercial mortgage sector, particularly given their kind of conservative way that they participate in that market.
Yeah, again, big difference between life insurers and banks here, as you alluded to. But look, I think the commercial mortgage market as a whole is under pressure. If you take a step back and, if you travel, and I'm sure Steve, you and Ken and many of the listeners travel to some of the cities, and you see buildings empty when you go into downtown in some of the cities, it's office exposure is a risk that's out there. And so we continue to be careful about where we put money to work within. But it's more important is just like anything else, just like writing a life insurance policy, commercial mortgage is similar to like understanding your tenant profile. So being in Class A buildings, for instance, Equitable, almost all of our office spaces within Class A buildings, that ensures that you're going to have a high tenant profile. That leads us to having over 90% of our tenants in place. And most of the industry is well positioned in this space. Now, it's a big concern for investors, Ken. I think the industry and the public side has underperformed really solely due to this risk that's perceived out there, because once there's a risk in industry, in the public markets, you're always proving guilty until innocent, at the end of the day. So it's going to take time, and the industry is going to show, going to have to show the resiliency, but it's not going to be one size fits all. For instance, your maturity profile, if you have a lot of maturities coming up in the next 2 years, that could put some strain on the system, whether it leads to downgrades in the statutory accounting. That could put some pressure on. We're fortunate we have less than 5% of our overall office portfolio matures in the next 2 years. So it's definitely manageable, but there are certain areas where there's risk. But I think in a large part, the overall industry plays in high quality office space. The LTVs reflect, if they're valued on an annual basis, should reflect the decline in markets today. And I think there's a lot more room that the industry can absorb in market deterioration. But again, it's understanding your tenant profile and good underwriting. That's what it comes down to.
Wonderful. And that's exactly what I'm seeing as well, kind of broadly across the industry in terms of the work that we do in this area. So let's go on to M&A. So Steve, if we could come back to you, what impacts are you seeing in the M&A space in the life insurance industry resulting from the current higher rate environment?
Very good question. I think, first of all, even in 2022, we started to see a slowdown in M&A activity in the life and annuity space from the fast pace we saw in the previous 2 years. And so far this year, we've seen a slowdown, particularly in the larger transactions that have been announced. But as you kind of look at it, step back from it, really higher interest rates can improve the valuation of a company or a block of business that may be being up for reinsurance or being sold. As a result of that, the investor or the buyer can reinvest cash flow supporting the liabilities at a higher investment yield. So that's really what causes that valuation to increase. So that really has probably caused some sellers to potentially look at this might be a good time to get out of a non-core or underperforming line of business. But the flip side of that is that the buyer's cost of capital has gone up. We talked about rates going up almost 500 basis points just over the course of a year. And so that's obviously caused, cost of capital to increase. And so buyers will tend to expect a higher return on their investment on the transaction. And as they look at the statutory cash flows coming off of a deal they may discount those cash flows at a higher rate. So that's one impact that could dampen the activity. Sellers may be more willing to dispose of an underperforming or non-core business, as I mentioned earlier, due to the higher valuation that's caused by the higher interest rates. And depending on the situation, it could also cause a seller to retain business where the higher investment yields can improve profitability going forward if they can reposition their investment portfolio that's backing those liabilities. So that's another impact. There've been some announcement of transactions recently in our space that started. Most of those, though, I think are started in the second half of 2022. So really time will tell over the next several months, whether we'll see a little bit of a pickup in activity. M&A is a space that we play in at Protective. We've done 59 transactions over the years. And, we were very disciplined in terms of looking at the cash flows and making sure we have the right assumptions around those, blocks of business that we're looking to acquire potentially.
Fantastic. It's like, so as interest rates have stepped up to a discretely higher level, it's time to take a fresh look at everything. Basically see what you might want to wind down, what you might want to make an increased commitment to. So that's wonderful. Robin, could you give me your perspective? So, Protective as a private company has their view to M&A. What's the public market view?
Yeah, look, I think Steve hit on a lot of the points. I think the bid ask has narrowed as a result of interest rates going up. And I think if you're a private company, you can say, do I need to transact in those liabilities that I thought I did rather than just hedge at the current position to neutralize your economic exposure across the board? So you have to think through that. I think for public companies, I think it's very difficult. Valuations in the public market are low. And, to be honest, it's a function of the industry losing trust of public equity investors with poor assumptions. So, whether you think of variable annuities pre-2008, then LTC, then ULSG, it's been a combination of continued poor assumptions that people have put on blocks that's led to this great private market for liabilities, because when you go private, it's a chance to almost reprice the in-force through a transaction. And so it may be perceived differently. But as a result, a lot of the complex longer-term liabilities are not valued well by public investors and are better held private. So that's, I think, the core thing that you continue to see happening. And so as interest rates increase and public companies have less exposure and the bid ask narrows, I think you could see more appetite for deals on both sides. But Steve made a good point. A lot of private companies are going to have higher return hurdles in this higher interest rate in markets as well. But I think the returns, look, these are, if priced appropriately, these are great liabilities with strong cash flow profiles. So, I think there's a good and robust market for these liabilities.
Very good. Let's move on to the topic of the opportunities available for product innovation and kind of the product set generally. So, Robin, if we could stick with you, focus on retirement savings products. So, higher interest rates really change the set of retirement savings products that life insurers are able to offer their customers. What do you see in terms of Equitable's priorities with respect to meeting people's needs with respect to solving that retirement security problem?
Yeah, look, I think it's a great opportunity for the industry across the board. If you look across markets all over the world, the U.S. retirement market, from a demographic perspective, from a tax perspective, is really the best market in the world for retirement products. So the question for insurance companies is, how do you capture that opportunity and reach the hearts and the minds of consumers out there to how we play? So I think higher interest rates offer us an opportunity to provide more attractive products that are more competitive to banking type products that they may see out there. We're a leader in the RILA market. That's a new market of buffered annuities that we developed in 2010, 2011. It's now the fastest growing part of the annuity market. That continues to be an accumulation oriented value protection for clients. The fixed annuity market in the US is probably the fastest growing over the last year as interest rates have increased. A lot of insurers, both private equity and traditional, have offered these fixed annuity products to clients that competes directly with banking oriented products. So we're seeing a lot of demand in that space. Equitable is not in that space because there's a lot of competition there, but we continue to see a lot of client demand for that. And then also, I think traditional liabilities, longer dated variable annuities that are priced appropriately can continue to be a differentiator for consumers in this market. But again, you have to price your assumptions to be realistic. You can't take bets on interest rates. So the opportunity remains, tremendous for the industry across the board. And you're going to continue to see, Ken, innovation in this place as rates rise and insurers continue to learn the lessons of the past and offer more attractive products to consumers.
And just connecting, all the points you just made about retirement security products to your past point about sort of behavioral assumptions on some of the old legacy lines of business. It did seem, as you were kind of laying out the future, the product designs that you're talking about are, dramatically less sensitive to those behavioral assumptions. I mean, they're just,
we call it, everybody talks about capital light. It's the new name that everybody uses in this. We say we want to design products around a narrow range of outcomes. Mm-hmm. When you test products through pricing, if they have a wide range of outcomes, they don't pass our internal hurdle rates. You not only have to stress, we talked a lot about stress tests earlier, Ken. You have to stress products for behavior, for interest rates and markets. And if you're taking unhedgeable risk, you must assume that it's on a narrow range of outcomes. Otherwise, Ken, we end up repeating the sins of the past at the end of the day. Again, this is such a great opportunity that we have in the market to provide consumers a need that others can't provide. And it's about capturing their hearts and minds and creating trust for U.S. consumers.
Wonderful. Steve, over to you. So as rates have increased, so what are your thoughts about product opportunities across all the major categories of life and annuities? What do you see as opportunities for the future?
Sure. I would echo what Robin said. There's a huge demand for retirement products right now with the aging population and, the need for guaranteed income for people that are coming up on retirement. And, our industry can provide that, source of guaranteed income through features and variable annuities and fixed indexed annuity products and so forth. But as Robin said, we've got to be prudent in terms of how we manage that risk as an industry and hedge it properly and do stochastic modeling to make sure that we understand what the tail risk is, because at Protective, we like to avoid tail risk. So basically, that's an industry that that's a segment of our industry, I think, that will continue to have growth opportunities. Protective, does play in the retirement retail business. We have fixed and variable annuities, as well as an executive benefits business that we call retirement business, which is really more corporate-owned life insurance, through banks and other corporations. Of course, the bank side of that has kind of slowed down just due to some of the lack of liquidity there. But we're seeing really high demand for fixed annuities. When you can get a crediting rate that's above 5%, on a fixed annuity, SPDA, or a higher cap rate on a fixed indexed annuity, that's a lot better than what consumers are getting credited on their deposits at banks, or even on some of their money market accounts and things. So I think as these rates continue to be at this level, we're going to see strong demand for fixed annuities in particular.
Fantastic. And you sort of alluded to life insurance companies' competitive position relative to other players when you talk about fixed annuities versus, say, what you can earn in a banking account. But just more broadly, Robin, do you have any comments in terms of how the new rate environment presents strategic opportunities for life insurers to improve their market share relative to banks, mutual fund firms, other competitors? And I'll also throw in there, just in the kind of the list of strategic opportunities, Steve talked about this dramatic demand for guaranteed income, particularly with the demographic changes in society. We had Secure Act 1.0, now Secure Act 2.0. Does seem like one strategic opportunity is just getting annuities into the defined contribution system. I mean, that opens up a whole new strategic area of growth. So it's just what are your thoughts, Robin, about strategy generally relative to other participants in the market?
Yeah, look, I think, again, insurers have to build back trust. We have such a huge opportunity. Steve just mentioned it. 11,000 Americans retire every day. Those are people that need offer advice, products, asset management services that we provide. And so it's about changing our perception in the market. And it really, for me, it's about building back trust. And as we build back trust, the overall part of the market that we play in should grow. It's a tremendous opportunity for us, and it's on us all as executives across to make sure that we position our companies the best way in the future to capture this opportunity. The Secure Act, Ken, you're right, it's a huge opportunity to access a wider part of the retirement market. We're big on in-plan guarantees. Our subsidiary Alliance Bernstein was first to the market 10 years ago, was pretty unique in their offering. It's a variable offering with them. It's a target date fund that buys annuity increments over time as it transitions to fixed income across. It's a huge market to play in. At Equitable, we don't really operate in the large 401k market. I don't think Steve does either. On it, it's a low margin and really difficult to really grow at the end of the day. But if you're operating and you can provide guarantees and products on your balance sheet and leverage an asset manager to do it, so they're to upfront take it, it's a great partnership to have. We've also expanded that partnership to BlackRock last year. So BlackRock's now coming out with their new offering. So we're really excited about this. We think it's a tremendous opportunity in the future. What I tell my investors, though, it's not going to hit the bottom line in the next 3 to 5 years, but 5+ years, we think this is really going to change the retirement market as annuities being allowed to become a default option, meaning they provide safe harbor for the trustees of plans to be included is really a game changer for us. So now it's about operationalizing and ensuring that you're with the right partners. And we're quite happy to be with Alliance Bernstein and BlackRock now.
No, you said the magic phrase, Robin, default option.
Yeah.
As annuities become the default option for the retirement income solution within defined contribution plans, that's going to lead to just an explosive growth potential for the life insurance industry. We saw that with the Pension Protection Act in 2006 for target date funds. Target date funds were a backwater of the mutual fund industry, and then they just went up, just grew exponentially. And now that the baby boomers are all well into retirement and plan sponsors need a default option for retirement income, the life insurance industry is first in line. So,
Alliance Bernstein was almost too early because when they came out with the product 10 years ago, it wasn't a default option yet. But
Right.
now with the Secure Act, and we saw those pains because when you're trying to incorporate in plans, trustees want the protection of being incorporated as a default option under Safe Harbor, which now the Secure Act provides. So now I think with some of the work that asset managers and insurers will do together, it becomes a viable solution over the long term for 401k plans. And then again, it goes back to capturing that need in the U.S. retirement market.
wonderful. Steve, if you could close us out, what are your thoughts on strategy generally, particularly, for the life insurance industry vis-a-vis other competitors, mutual funds, banks? Robin talked about working in partnership with the asset management industry. Over to you.
Sure. I think our industry is uniquely positioned to take advantage of this opportunity, of this flow of money that we know is coming, and banks and mutual funds and other firms have taken advantage of that. But we have, like, even on a SPDA, we have the ability now to credit a very attractive rate, and there's tax advantages of offering an annuity that don't come with just a deposit at a bank or a mutual fund. So I think we're uniquely qualified on that to manage the risk of some of the guaranteed income features in the products. And with our conservative investment approach, I think our industry will get in the flow of some of that money, and should, based on our ability to be competitive and offer attractive products to consumers at this point in time.
Wonderful. Well, I couldn't come up with a better way to wrap up our session today. So, Steve, Robin, on behalf of the International Insurance Society, thank you very much for spending some time with us and sharing your thoughts.
My pleasure.
Thank you.